is the fact that they're bringing a lawsuit saying that when we told you, let's say there's bugs, there's roaches, there's rats, you never did anything about it. So then the insurance company comes back and says, hey, did they tell you? They told you all this stuff. They're saying they gave you 5 notices. They never did anything. So the insurance company comes back and says, hey, you're the landlord. You should have told us the first time it happened. How come you didn't tell us to a point where it became a lawsuit?
Right.
So that's the thing, that angle that the insurance companies take and deny claims for habitational. Or it could be just outlined, excluded.
Hi, this is Chris German, and welcome back to the Apartment Dealer Show. Today, the topic is property insurance is probably one of the number one things plaguing property owners here, especially in California. You may even recently had been issued a notice of non-renewal, and that's what we're going to dive into. We're going to discuss what you need to know about coverage and liability. And to discuss all things insurance with me today is Mr. Gino Mattunts.
Thank you, Chris.
All right, sir.
Thanks for being here.
I don't want to slaughter your name there, but now we brought Gino on the show because here of late, he's helped a lot of my personal clients get out of a corner where either they were issued a notice of non-renewal, they were purchasing a multifamily property, and the insurance broker they had used for years and years all of a sudden did not have a carrier for them. Gino's been a lifesaver in that way, and he's here to share with us what you need to know about how the landscape has changed, what you need to know about really your coverage and some of the things that you should be aware of, even in your existing policy. So even if you're one of the fortunate ones, you're not having an issue with your insurance carrier right now, that may soon change. But even still, I suggest you lock in to, as we dive into, what is it you need to know? What is it you need to piece apart in your own policy? Now, you've been at this for 26 years.
Yes.
And so on the landlord's minds, of course, is all of a sudden this year, policies are doubling and tripling in cost. All of a sudden, I mentioned the issues with non-renewal. I imagine this has changed the landscape of your business, what the insurance carriers are doing at this.
So pretty much since 2 years, the main problem with the insurance companies was the cost of construction going up. So when the cost of construction went up, and the claim cost went up, the severity of each claim went up. The insurance companies arguing that they are not making enough money with the policy, that the premium they're taking in. So they want higher rate. They want to get higher rate. It's very tough in California to get a rate. So they're stuck with Department of Insurance's laws and requiring them to get only 6.9% rate increase. Imagine a carrier that needs to get a 30% rate increase. They're stuck with Department of Insurance trying to go through the process for 3-4 years, maybe more, to get to that percentage. So now they're stopping and figuring out ways to non-renew people to get the book off so they don't pay the claims that they're anticipating to pay.
So the bottom line is this all stems from their profit margins.
Exactly.
It's not that they woke up one day and said, well, maybe we don't want to do apartments in California. They took a look at the profits, their losses, and said, hey, it's not worth it.
It's not worth it. Yeah, so they're saying they love to write the accounts. They're good. Everything is updated. Roof is good. Electrical is updated. Plumbing is copper. So if they don't just want to not write anything. They want to write it, but they want to write the best of the best shared apartments. And people, they own apartments built in 1930s, 1940s, 50s. Right. Nothing has been updated. But these carriers had never asked those questions. Has the electrical been updated? Or even if they asked, they never checked up on it. They never went back and did an inspection. Mm-hmm. So now they have to get out of all this book of business, get out of it, re-underwrite it with the current guidelines that they have to be able to either get more premium out of the landlord or not write their account.
Wow. So that's the state of affairs, and that's kind of what's hovering over our conversation for today. Of course, we had questions submitted by some of our closest clients, landlords that we work with. And so to start kind of ground level, we'll build from there. Can you provide a detailed breakdown of the coverage options available for multifamily properties and what specific risk and liability should be addressed in the policy?
So main, obviously, is the coverage is the property, the investment itself. We want to make sure that the building is covered. Then the liability that comes with owning a multifamily property, that it could be liability from lawsuits from tenants, from people that just go about their business in that property. And then another thing is the income loss. So you have to make sure that those three things are the most important things: property coverage, liability, and the loss of income. Those, I would say, must be on every policy.
Where does the responsibility fall for a landlord in terms of being aware of needed maintenance? In other words, let's take a staircase, for example. Let's take something really egregious. A staircase just falls and collapses, somebody's on it. Now, was it for the landlord? Should they have had it inspected by a staircase professional every year? Like, what is the insurance carrier looking at to say they're either going to cover that loss or deny coverage?
So it's hard to say what they'll look at unless they see real negligence from the landlord. Let's say that there was 2-3 claims, somebody slipping, falling, there was a crack on it, things like this. And, if there was real negligence, if one day somehow that stair broke as a person was on it and that person fell, that wouldn't be any negligence, I don't think, from the landlord's perspective. But if that staircase was broken and there was several notice given by the tenant saying, hey, this one of the stairs is loose, and we just didn't do anything, to a point where one day somebody fell, that would be something that the insurance company could go back and say, hey, you knew this was going to happen. And even then, it's hard to not cover it, I think. It's very hard to not cover that liability. It'll be a hard battle for the insurance company to not cover that liability, even though the person was notified that there's a problem with the stairs.
So let's talk, because I've had a personal experience with this one, and I would eventually guess many of the viewers aren't aware of this. Let's talk when there's a water leak in a property. So I learned the hard way that if there's a water leak, and let's say you have no idea it's there, it's just a slow drip, but it's gone on for a length of time. Yep. So by the time the wall's bubbling, or by the time you have evidence that, oh, I have a problem, they send the adjuster, there's already mold that's built up. So the adjuster comes in and says, well, this isn't a sudden burst. This has been this way maybe for a month, 2 months, maybe longer. And in California, the insurance companies have a special get out of jail card where they say, hey, we don't have to cover that. So can you explain that a little bit? Because I wasn't aware. I just assumed all leaks were covered, and then I got hit with that.
Yeah, so that is one thing that they won't cover. So even if it's, let's say, a roof leak or a little pipe somehow had a nail in it or something, or it's slow, just the drip. And you don't notice that until paint color changes. Sometimes it's behind the sofa, people pull it out, then there's like major, discoloration in the back. So those are things that the insurance company will not cover because it's a maintenance issue. So you could have put in like a leak detection in your building that would trigger some kind of a notice to you saying, hey, we're constant usage of water in this building, which it's not something that costs a lot, but it's just a lot of proactive measures you have to take to make sure that you're doing things to prevent from loss. And if you're not doing things to prevent from loss, then the insurance companies can come back and say, well, you were supposed to protect this building, be a good landlord, make sure everything is fine, and you just neglected it. And that's why we're having this issue. We're not going to cover because you neglected the property.
Yeah, I mean, my argument was, how was I to know this leak was in the wall? It's not like now maybe the leak detection, so that's a good one. They could have said, they didn't bring that up, but anyways, they didn't cover my issue, and so I came out of pocket. That was fun.
That happened to me too.
Really?
Yeah, that happened to me too.
Yeah,
and with a very good insurance company. Yeah, I thought they would come in. I've been with them for 10 years, no problem. They just came in, it's the exact same thing. Nope, not covered.
Yeah, they had several of my properties, several years. I'm the apartment dealer after all. None of it worked. None of it worked to get the coverage. All right. Next question the audience had was replacement cost versus actual cash value. How do insurance policies differ in terms of replacement cost versus actual cash value? And what factors should be considered when deciding between the two valuations?
So this replacement cost or the actual cash value started coming into play because of this current situation that a lot of people are in. And the reason is because the insurance companies, when the updates are not done, they don't want to do replacement cost coverage. They are okay giving you an actual cash value coverage. The difference is one is replacement cost. They cover the property to whatever current replacement of that property cost could be. And they guarantee the replacement of the property without depreciation. Actual cash value is the actual cash of that property, whatever you have on the policy amount. Let's say you bought a coverage for $1 million. That actual cash value of $1 million minus the depreciation of whatever is damaged. So it's a lot less coverage. It costs less to purchase an actual cash policy versus replacement cost coverage. But I don't like selling actual cash value.
I would imagine it's not very prevalent.
You're not going to be happy at the time of claim.
Mm-hmm.
You're going to feel like you're being nickel and dime on everything.
Mm-hmm.
And at the end, it's not worth it. I don't think it's worth to purchase unless you have to. Like a property is just impossible to insure any other way. You have all the electrical panels that are ones that the insurance companies don't like Pacific Federal, Zinsco, and they have a list of those that they don't like. The roof is in bad condition. You might even get a roof exclusion. So things like this. If the property is in really bad shape, then you have to get an actual cash value, then you might as well get that. But, at least knowingly that what you're buying is not something that is going to cover you.
Potentially cover the entire.
It's not going to cover the entire damage. So if you have a, let's say, $1 million policy, you might get like $800,000 when all the
depreciation
stuff taken off. So it's not, I bought $1 million, then at least pay me $1 million. No, it's whatever is damaged, and then depreciation of that particular, let's say, drywall cost depreciated. That's all used. So things like that.
Well,
yeah.
So it's cheaper, but
it's not recommended.
It's not recommended. Okay. Loss of income coverage. In the event of a covered loss such as fire, natural disaster, how does the insurance policy address loss of rental income for the property owner? What are the limits and conditions associated with that coverage? And how can a landlord ensure that they're adequately covered? So I know that's three pieces. So first, essentially, the rental income of the property, how's that determined when they're looking at the loss?
So loss is obviously you have rental income. Each unit has cost. Your income is based on that. So there's several ways the insurance company states loss of income. One of them is actual loss sustained and gives you a time period, 12 months or 24 months. So they don't really get into how much you're making in the beginning of the policy. So you just, let's say you say, okay, I'm taking in $200,000 from this 5 units annually. That doesn't mean at the time of the claim, you're taking again 200. You could have rents increased to 300 now, so then at that point in time when claim happens, then you prove whatever your income was, and let's say you get a 12-month window or 24-month window of actual losses sustained if you can't rent those units out. Then there's another type, like the same way, like actual replacement, actual value, is carriers. Now there's a lot of that because of the non-admitted carriers coming in to the market because of all the regular carriers, admitted carriers leaving the property, habitational industry. They started doing stated value income. So you state, and that's something you have to pay attention, is the agent has to know exactly what income you're taking from this property and up to what amount you're okay to take back. So let's say if it's $150,000 income, you make sure that the agent at least puts in $180 So to get coverage for at least 180 loss of rent. Otherwise, if it's something less, a regular claim, just permits and things like that could take you 12 months or more to get that unit back on the market again.
Right.
So that you have to anticipate at least a year.
And since you're raising rents over time, is that something that the agent is, annually has to continue to address, or how does that look at? Let's say the claim doesn't happen for 5 years down the road. Obviously, your income is much more than
you have to every year renewing it. You have to make sure that they increase the loss of rent. So on property, there's inflation guard. Carriers have an inflation guard protection, so it will increase the property value by 2%, 4%, whatever you choose, but not on loss of rent. So every year, unless you have a policy that's built in 12 months or 24 months. So at that point, you don't need to say anything. You just renew your policy 12 months. At the time that claim happens, you just prove what your last 12 months was.
Okay, got it. How can property owners ensure that they're adequately protected? Is it simply just the ensuring that the agent is on point with that income amount? And I guess in the policy itself, is it on, page 1, it states what the income is, or how does the consumer double check that the agent has listed the right income?
Yeah, Chris, honestly, I've yet to have a consumer ask for income. They don't think of it. So the agent has to be a little more proactive. When it comes to property coverage, loss of income is the same as property as far as coverage. So if, let's say, you have 1 million property coverage and you have 200,000 allocated to loss of income, so the property coverage could have been 1.2, it might have been the same price. So the agents have to, I think, do a better job of asking the client what your income is on this property, what rent, or you might have an idea yourself, So you just calculating, let's say, a unit like that, $2,500 times 12 times however many units are in there. I like to over-exaggerate on loss of income because you never know. Yeah, I've had clients where loss of income played a big role. Property fire, and the back unit burned. He had to red tag the whole place. The 4 units had to all move out because the smoke. So now only little property in the back is burned, but the whole place can't be rented out until that's done. Clean up, all this stuff happens. Wow. So
you can overestimate. They won't fault you for that because obviously at the time of claim, then they're going to say, okay, show us the rental.
Show us the rental.
Okay.
Yeah.
Okay.
But you must have it on.
Yeah. Okay. Policy exclusions and limitations. Can you outline any common exclusions or limitations that property owners should be aware of when they're insuring their properties that maybe they're not aware of? Their agent didn't bring it up to them to say, hey, here's some things you need to consider that are actually excluded.
Main things are the limits, coverage policy limits and stuff, deductible. And then a lot of liability, talk about with your agent about the liability coverage or losses that could come up. And if the insurance company is protecting you over those things. Lately, a lot of lawsuits are coming for habitational use. So it's small claims, but if the insurance policy is excluding habitational, then you're kind of end up paying even this $20,000-$30,000, but it's...
Is that common for the insurance companies to exclude habitation?
So the thing is that part of the habitation is the fact that they're bringing a lawsuit saying that if when we told you, let's say there's bed bugs, there's roaches, there's rats, you never did anything about it. So then the insurance company comes back and says, hey, did they tell you? They told you all this stuff. They're saying they gave you 5 notices. You never did anything. So the insurance company comes back and says, hey, you're the landlord. You should have told us the first time it happened. How come you didn't tell us to a point where it became a lawsuit?
Right.
So that's the thing, that angle that the insurance company's taken, deny claims for habitational. Or it could be just outlined, excluded any habitational claim. So you just want to make sure that it's not.
Wow. Well, especially here in California and Southern California and even closer, like say LA County, San Bernardino County, because the number one, if someone doesn't pay rent and you give them a notice, you start filing for eviction. There's a form they fill out if they're going to answer. And they can check all these boxes of what you did wrong as a landlord. Habitation is always the box that they're going to check. So the fact that might actually be excluded, you viewers, I suggest you take a look, talk with your agent, because that is going to be their defense amongst others in the event of an eviction. So market conditions. So we've talked a little bit about this, what factors led the insurance companies. Essentially, we're talking about it boils down to profit. They're saying, hey, wildfires and floods and all the rest, we're getting sued now more than ever, probably by tenants and so forth. So losses, we need to increase the premiums, or hey, we're out of California altogether. We choose not to do business here. Can you provide insights into how it might impact coverage, availability, premiums going forward? Do you see this getting better? Is it actually tightening up? What do you think is going to happen, say, over the course of this next year?
It's hard to predict, Chris, but Department of Insurance is under a lot of pressure from politicians in California specifically, with big ambitions to run for, president, whatever they might want to do.
Right.
So they want the state to open up and go, be good for business. So Department of Insurance is under pressure to comply with the requirements of the insurance companies and make it into a free market of, let's say, A insurance company wants to charge X amount, the B insurance company wants to charge another price. Let them compete. The Department of Insurance is not letting the insurance companies raise rates. So when they go in ask for rate increase, sometimes they go in and they come out with a rate decrease, because then when they open up the books, they're not really losing money. So then the insurance company says, hey, the Department of Insurance says, hey, you're not really losing money. Why do you want to increase more and get higher rates? So now the Department of Insurance, when they did, the insurance carriers, all of them at once did the same thing. They all left. Then the Department of Insurance has to comply by them, has to open up the state. It's impossible to continue like this. So I've heard that the Department of Insurance is allowing the carriers to ask for rate as much as they want and see what happens. So hopefully they'll just let the insurance companies take their 20, 30%, whatever they want, and let the market go back to what it was. So the insurance companies compete for your business.
And so is this going to be, as best you can tell, is this going to be across the board, not just rental properties, commercial properties, but it's going to be single family homes, primary residence, automobile insurance? Is it going to be across?
It's every one of the markets, personal auto, homeowners, renters, they're all in a big mess right now. So the insurance carriers, all of them tightened up. In my own agency, personal auto, writing a personal auto has become a nightmare, where before we didn't even ask questions. We're just getting the driver's license, registration, VIN number, not even registration, initial policy. Now, just for personal auto, you would have to take photos of the car. You have to go through all this stuff. And if you might get a call from your current agent saying, before we renew you, you have to provide all these things to us. Registrations, pictures of the cars, VIN numbers, the cars.
Yeah, I just got hit from pictures of my daughter's car. And I thought, that's a new one, but it's...
So the reason they're doing that is for you not to comply. When you don't comply, it gets not renewed. So what they want you to do is fall off their books with the current rate you're paying and go back when your rates are higher.
Yeah.
So that's the only reason they're doing this. They're saying they cannot sustain business with the current rates. So it's everyone wants to get a higher rate, and prices everything has gone up.
Well, sure. There's some argument to be made that, hey, like you said, construction costs has went up, materials and labor, so it's going to cost them more if there's a claim. Lawsuits have increased, especially here in California from tenants. There's going to be losses there. So there's an argument. Yeah. I guess, though, when you said 20, 30%, some of the viewers heard that and said, oh my gosh, if all my policies go up by a third, and some of these people are sizable owners, that taps into your cash flow.
Every day I have that hard conversation with clients. I get clients get a non-renewal from their current carrier. They're used to pay $3,500, let's say, on a property that is $1.5 million replacement cost. Nice coverage, everything there, business income, liability, everything, $3,500 on a, $1.5 million coverage. Now you go back to them, even if you try your best, it's at $45,000 to $5,000 premium. And not until it comes to a point where they really realize that there's nothing else out there. And they're like, well, we got to do it.
What choice do you have?
But if they got their renewal at increase by 30%, I was just having that conversation today on the way here. Client called me asking for a quote on a property that's getting, I didn't know at the time that it was non-renewed. It was a Mercury policy being, now that I know it's being non-renewed, but before I didn't. I was just quoting it. I gave him a price, and it's a good client of mine that I don't write all of their properties, but write a lot of their properties. So I didn't want them to go through the inspection again. So I told them that if you got a renewal, might as well pay that renewal, because if I write it, you're going through inspection. And I know the property is not in the best shape. So if you can avoid the inspection, it might be a good idea to pay that extra premium, but they weren't renewing it. So we have to go through inspection. There's carriers that are a little more friendlier on inspections than others. So we just have to pick and choose and figure out what's best for the client.
Now, I was mentioning to you that I just received a letter of non-renewal. That's a lot of fun on a building that I own. But as we were talking about the construction style, and I didn't realize this because this property here is multi-unit, but they're single-story units and they're detached. So we have a couple duplexes, and then you have some individual bungalows. And then you said, oh, well, that actually is a good thing. Maybe you didn't have the best coverage to begin with. You should have individual policies. Explain to the viewer why, if they have that type of construction style, the advantages of having the individual policies, especially in light of all the challenges right now.
Yeah. So if you have a property and that's multiple units, over 5, and they're in one lot, there are several buildings, let's say duplexes, triplex, or fourplex, or single families, just a mix, and they all have their own individual addresses. You can purchase a policy for each one of the buildings separately. Now I find it easier for the landlord to purchase those policies than one policy that has all the addresses listed. So if you have a property like your policy that you were mentioning, if you look at that policy deck page, you'll see every one of the addresses listed and the coverage separately written for each one of the buildings. So in essence, what the insurance company has done is gave you a policy with list all the buildings on one lot. So location 1, unit, building 1, 2, 3, 4, 5, cost for each replacement of each unit. So, and you're getting one bill. So it's easier for you to manage. But you can do that essentially the same thing with one company, just have 5 different bills to pay. The reason why that might be better, because carriers that write those type of policies currently are not as stringent on guidelines as the ones that are writing apartment buildings. So you might get it might not continue for long. Next year, they might start doing the same thing.
Right.
But at least you'll buy a year to get, we don't know what will happen in 6 months. Everything might be back to normal, might be able to write any policy again without going through all these problems. So right now, I think in your situation, that'll be the best way to go.
At least, look into it.
Yeah.
And you mentioned you might even avoid inspection, right?
Yeah. So besides avoiding inspection, the carriers don't even ask the question. So if the electrical panels have been updated or not, sometimes. So
that's the main thing landlords are getting hit right now.
Exactly.
Yeah.
So if your roof is in good shape, you bought the building 4 years ago, let's say, you never touched the roof, but it's in good shape. You can't prove if it was fixed a day before you purchased it. So, but the electrical panels are right there. They can open it and see it's bad. You can see it's bad. You can see it's old. And the roof, you can't tell if it's old. But the question is, has the roof been updated within the past 15 years? And if it, to your knowledge, it is, yes.
Or to the naked eye, it looks as though, right?
So on the electric panels, if they're any one of the bad ones like Civics Federal, Zinsco, there's one other one, I forget the name, I think.
Stab block?
Stop block. So if any one of those is existing on your panels, the insurance companies don't want it. But in policy, like I was telling you to purchase, there's no question about the electrical. So you could just purchase a policy. The insurance company doesn't even come to inspect the electrical. And that is the way for you to bypass that electrical issue.
That's going to be very helpful to a lot of the viewers because, again, especially here in Southern California, there's a lot of properties are constructed that way, and in their individual places. And you pointed out the fact that they have individual addresses. So if you have individual buildings, but let's say it's A, B, C, D, E, F, G sort of thing, does that not work? That doesn't work.
Yeah.
Wow.
If you have separate buildings, but it's a unit A, B, that won't work because it's part of the one address. So if let's say 1811, I don't know, Stalker Street, and unit A, B, C, D, and they're separate, that won't work. So you have to buy a policy that's all one shot.
Wow. Okay.
Yeah.
Alternative insurance options. So in light of, the limited options that we have today, maybe if you could talk a little bit about, people, they get California Fair Plan, then they have something for liability. If they got that non-renewal, their building is in a state where they can't update the panels all that easy, right? Without spending a lot of capital. What are some of the alternatives?
Obviously, California Fair Plan is there. They just increased the limits to $30 million. So you can, if you're commercial, multifamily, you can buy a coverage all the way to $30 million.
And how does California Fair Plan differ from, say, a Mercury policy?
So Fair Plan is only fire. They don't cover water damage. They don't have liability. There's vandalism and fire that they cover. And that's it. It could be brush fire. It could be fire that started from gas break, fire. So then you have to buy a separate policy that covers liability, water damage, and other perils. And that's not going to be possible. Maybe you can buy liability, but you can't buy water damage. So
water damage is not going to be
so water
habitability.
The liability will cover that.
It will cover.
Yeah, that's part of liability. So if you find a policy that is not bare bones, but when you don't buy everything like a package, then the carriers that sell separate things like liability separate or umbrella separate, those carriers tend to do bare bones coverage. So not the best place to be.
You have gaps.
Yeah, you have gaps. But in the property, I've done a couple of Fair Plan policies where the owner was saying, "There's no way I'm not putting $1 on this building." So we had to do Fair Plan because if you buy a policy that even though the insurance company is okay to insure it, they come and inspect it, they're going to ask you to change those panels. So if you don't want to change the panels, I know the panels are there. He knows the panels are there. He doesn't want to change the panels. He wants to keep the policy coverage, let's say to a certain amount, but doesn't want to touch the panels. Then he's going to end up paying the premium on insurance and not even get the coverage. So I really don't suggest people doing that. I think it's a better idea. I mean, it's their property. I can't tell them what to do.
Sure.
But to pay $10,000 to insurance carrier and not have coverage, rather spend that money on your building.
Right.
And get a really good policy.
Yeah, makes sense.
So I think it's better right now for landlords to, as far as the insurance is concerned, go with a carrier that gives them time to fix the problem and update their building and keep the insurance costs low rather than buy a policy that's really expensive. And
not only do you not have the coverage, it's really expensive on top of it.
Expensive. Yeah. I'm not sure how much it'll cost to change the panel. Depends on the building, depends on the size, how much wire and all this stuff. But it's probably the same thing you'll pay for insurance. It's going to be expensive.
It's going to be expensive
if you don't want to touch it.
Yeah. Yeah. All right. So let's talk about, as landlords move forward. So mitigating risk. So what proactive steps can landlords take to mitigate the perceived risk that's associated with multifamily properties that would make their properties more attractive to carriers? Are there risk management strategies, that they can implement?
Yeah. So main thing right off the bat that the insurance companies look at is the housekeeping of the property, if it's clean. If there's no bars on the windows, if the paint is not chipped, because at first glance they can see it. First glance, they can Google Earth view, drive by, or they have satellite capabilities to look at recent satellite photos of the property and calculate debris in the backyard, things like this. They have a lot of technology in their hands now. So that first look is where you want to, at least from the outside, make sure the property is clean. And then from that point on is the other stuff that you need to do. Make sure the water heater is strapped, plumbing is up good, electrical is good, all that stuff that you have to do. Make sure the exit signs, fire sprinklers, all this stuff that is required. So if you have, wood burning stove rack unit right next to the building fire pit, they're not going to want that. So they want to make sure that this property is not going to give them problems. And that's the whole essence of the insurance company requiring inspections. So they come in, they have a professional that looks at loss. I mean, these guys, know what claims could come from. So they have, within 30 days, they'll come in, inspect the property, and give you a spreadsheet with all the problems. You just have to fix those if you get that done. Some of them could be more expensive. Some might be as easy as trimming a tree back. But those things end up costing the insurance company money. And then when the insurance company pays out, that claim stays on your history, on your property. Then your next year's insurance premium goes up. It's just a slippery slope that you don't want to be on. So,
what if you have multiple policies with the same carrier and you have a claim, let's say, on one property that they have to pay out? Does it potentially affect the other properties if they're individual policies? Do you get a black eye now because, hey, we've had one claim with you, so now we're,
So I've seen that happen a lot so the insurance policy itself has a loss ratio percentage. So let's say if you have a policy, you're paying several properties, let's say you're paying $30,000 for all the buildings, and then you have one loss from one of the units, and the insurance company pays $30,000. So right now you're at 100% loss to this insurance carrier. If that happens again, you're at 200% loss to the insurance carrier. So they're saying you as a client of ours gave us 200% loss on the money that we took from you. We don't want you as a client. So they keep that ratio. Or if they could, if you're able to explain that, say, this one property was bad, let me take this property out and continue my relationship with the other properties. And if that works, then you can keep it.
So it is something they look at, though.
Yeah, of course. The loss ratio, definitely, every year. Every year before you renew, the underwriter will look at your property, will look at your loss ratio, and say, send me an email saying, Gino, we don't want this client anymore. Figure out another place for them, or get rid of that one location.
Wow.
Yeah. It's a conversation we have as an agent and underwriter before you get notified.
Right.
So, but yeah, they look at that stuff. They could even come back and tell me, if you write any of these guys' accounts, we're not going to work with you.
Wow.
Yeah.
As the broker.
As a broker.
Wow.
So they don't want me taking anything from that person back to them, because some people just get happy with claims.
Yeah. Well, and they're in the business to make money, right?
Yeah.
I mean, maybe too much money, some people would argue. Lastly here, what recommendations do you have for property owners to reduce the risk of insurance claims? So maybe said differently, when it comes to multifamily property specifically, what claims do you see most often? And you're thinking to yourself, well, if everyone just did X, that would reduce the chances of this. What are some of those common things?
It's hard to say, Chris. Sometimes it just becomes the culture of the unit, like that apartment. One tenant does something, then talks about it with the other tenants, and there's just everybody else. You just like wildfire. Everybody starts doing that same thing. It's hard to say, but you just make sure that if your tenants are happy, building is good, there's nothing you can really do as a landlord. Just make sure the building is in good condition. It doesn't going to cause these issues for you. And then the other stuff you can't really control,
And if there is a claim, make sure that they can't prove negligence and these.
Yeah, and sometimes especially now insurance costs has gone so high. I always end up, recommending my clients to buy a high deductible and to cover the cost to go down. And if you have a high deductible, sometimes it's something that you want to stop the claim, pay for it a little bit, and before it gets to the point where you have to present it to the insurance company.
Right.
And if you do end up, presenting it to the insurance company, is it worth for you? Because if they pay, let's say $3,000, and then next year you lose that policy that was saving you $5,000 because the other one is more expensive.
Right.
It's not worth it.
Yeah.
So it's a conversation you have with your agent. Make sure you're with someone that specializes in multifamily. They're giving you the right advice, and continue that relationship. And
that's very, very important, because I can't tell you how many times, let's say it's an investor who's new to multifamily, and their agent swears to them that, we can insure multifamily properties, and then we're all going in circles for 2 weeks because they haven't been able to bind coverage. And it's like, well, maybe you need to really talk with somebody. Maybe they're not the one.
Yeah.
So, and again, like I mentioned at the opening, on the onset here, that you've gotten several clients out of a sticky place who, again, either their broker couldn't perform, or given the property, they just couldn't land coverage, and you've been able to bind coverage. So if the viewers would like to get a hold of you, what's the best number, email? What would be the best way for them to contact you?
They can email me, Gino at Gino Mattunts at allstate.com.
Okay.
They can email me there. They can call my cell phone at 818-681-1119. It's the best number to text or call me.
Yeah, it'll be right here along the bottom of the screen when we're done. So
I'm always available.
Email or cell phone.
Best way to contact me. I like to talk to potential landlords first time, and then if need be, I'll have one of my associates handle the rest of the stuff. But I like to make sure I'm having the first conversation with them to give them the right direction.
And if there's somebody watching this that's saying, you know what, I have my insurance policy here, I just don't know what I'm reading. Gino brought up some good ideas. I wonder if I have gaps. Is it something where they can send you their policy, you give it a review, and then obviously help them if they need?
Yeah, if they're comfortable with that, they can email me their policy, and then I'll review it, see if it's any gaps. They should maybe do some endorsement before, because nowadays, if they're in a non-admitted company, last week we had the same conversation with the client. They just went into escrow. I did a policy for them, and 2 weeks before, they had renewed another policy that was non-renewed with the agent, with their current agent, and they went into a policy that was 2 times more than premium, was 2 times more than what I could have given them on that property, and they had a 25% cancellation. So they were stuck. I reviewed that quote. I told them, come back in 3 months, get your 25% worth, then come back, and then I'll write something else for you.
And that's a new thing too, is this cancellation policy that wasn't there. So we'll have to have you back and talk cancellation, talk earthquake insurance, and all the rest. So, sir, well, thank you for being with us.
Thanks for the opportunity, Chris.
Yeah. I know the viewers appreciate it.
Thank you.
I hope you found today's episode informative. Be sure to reach out to Gino if you have questions about your coverage. Do you have gaps? You don't want gaps. You want to be sure that insurance there's plenty of things to be concerned with in the state of California. As a landlord, insurance need not be one of them. Again, I hope you found our show today informative. Subscribe to our channel if you have not done so already. Give the video a like, share a comment. Gino and I are curious on your thoughts on today's show. And until next time, this is Chris German, the apartment dealer, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.